Hello everyone and welcome back to another video. In today's video, I want to show you all what Warren Buffett himself had to say about Berkshire Hathaway purchasing Amazon. So I just wanted to make this video to show all of you exactly what Warren Buffett himself had to say about this investment. So let's just hop right into it.
This question is from Ken Scarbeck in Indianapolis. He says, with the full understanding that Warren had no input on the Amazon purchase and that relative to Berkshire, it's likely a small stake, the investment still caught me off guard. I'm wondering if I should begin to think differently about Berkshire looking out, say, 20 years. Might we be seeing a shift in investment philosophy away from value investing principles that the current management has practiced for 70 years? Amazon is a great company, yet it would seem its heady shares 10 years into a bull market appear to conflict with being fearful when others are greedy. Considering this and other recent investments like StoneCo, should we be preparing for a change in the price versus value decisions that built Berkshire?
Yeah, it's interesting that the term value investing came up, because I can assure you that both managers and one of them bought some Amazon stock in the last quarter, which will get reported in another week or 10 days. He is a value investor. The idea that value is somehow connected to book value or low price earnings ratios or anything, as Charlie has said, all investing is value investing. I mean, you're putting out some money now to get more later on, and you're making a calculation as to the probabilities of getting that money and when you'll get it and what interest rates will be in between, and all the same calculation goes into it, whether you're buying some bank at 70% of book value or you're buying Amazon at some very high multiple of reported earnings. The people making the decision on Amazon are absolutely much value investors, as I was when I was looking around for all these things selling below working capital years ago. So that has not changed. The two people that, one of whom made the investment in Amazon, they are looking at many hundreds of securities, and they can look at more than I can because they're managing less money and their universe, possible universe, is greater. But they are looking for things that they feel they understand what will be developed by that business between now and Judgment Day and cash. They are absolutely following value principles. They don't necessarily agree with each other or agree with me, but they are very smart. They are totally committed to Berkshire.
From this first point, we can see that Amazon was bought by a value investor who works for Berkshire Hathaway. Warren Buffett himself just admitted that Berkshire buying Amazon was in fact a value investment. This is very interesting because there's a lot of people out there who think value investing is dead or that value investors can't invest in businesses like Amazon. This could not be further from the truth. Value investing is simply paying attention to the amount of cash a business will generate for you as an owner from now until Judgment Day, or essentially until you die. If the underlying business will generate you more cash than you're paying today in a reasonable amount of time with a reasonable amount of certainty, then you have a value investment. Investors today still get this whole idea wrong. They think that a high price to earnings ratio means that you can't invest in a business under value investment principles, which leads us very nicely into point number 2. Value is not connected to book value or price to earnings ratios. After the first point, we can see why this makes sense. An investment should simply focus on how much cash you as an owner are going to get out of the business you're looking to invest in. We can use book value or price to earnings ratios to help guide us, but they should never be a limiting factor in our analysis. Sometimes with investing in today's world, price to earnings ratios don't even give us a true indicator of the business's earnings. We can actually use Warren Buffett's Berkshire Hathaway as a wonderful example of this. In Warren's 2019 letter to shareholders, he wrote this: Berkshire earned $81.4 billion in 2019, according to generally accepted accounting principles, commonly called GAAP. The components of that figure are $24 billion in operating earnings, $3.7 billion in realized capital gains, and a $53.7 billion gain from an increase in the amount of net unrealized capital gains that existed in the stocks we hold. Each of those components of earnings is stated on an after-tax basis. That $53.7 billion gain requires comment. It resulted from a new GAAP rule imposed in 2018 that requires a company holding equity securities to include in earnings the net change in the unrealized gains and losses of those securities. As we stated in last year's letter, neither Charlie Munger, my partner in managing Berkshire, nor I agree with that rule. What this essentially means is that now Berkshire has to report the unrealized gains or losses in the stocks that they hold. And for those of you who may not know, Berkshire Hathaway holds hundreds of billions of dollars of unrealized gains in stocks. This simply just means that after 2018, with this new accounting rule, Berkshire's reported earnings swing wildly. And if we go and take a look at Berkshire Hathaway and their most recent quarterly reportings, we can see this is actually happening. In the two most recent quarters, the earnings have swung from 29.16 billion in earnings to 49.75 billion in losses in the span of just one quarter. So if you're trying to value Berkshire based on reported earnings and price to earnings ratios that swing like this, then you will never get an accurate picture of the true value of Berkshire. This is just one example of why we should never put too much weight on any one financial ratio or number. Instead, we should always look at the underlying business, what it produces in cash, and what its estimated future looks like. The third key point is all investing is value investing. This quote actually comes from Charlie Munger. What they mean by this quote is literally that all investing is in fact value investing. If you're investing in something, your goal is to make more money than you put in, thus producing you a gain on your initial investment. As a value investor, that's all we're ever trying to do. We focus on the underlying businesses and what they will produce for us in cash over a long period of time. Warren likes to constantly refer to his farm analogy when he talks about buying stocks, because he sees buying stocks just as buying a real business, as we all should. In his farm analogy, he says that all you have to do is look at how much the farm will produce for you in cash and in how long. You wouldn't buy a farm for $1 million if it were only going to produce you $10,000 in cash every year, because then it would take you 100 years to get your money back. However, if the same $1 million farm were producing $100,000 a year for you, then that would be another story, because after 10 years, you would have made all of your money back. And then from that point on, for the rest of your life, you would be making a pure $100,000 profit every single year off that investment. This is what value investing is, and it applies to businesses listed on the stock market or a farm out in the middle of nowhere. Every time you invest, you're looking at how much and how quickly you'll get your money back versus the price you're paying today. That is what they mean. Using this logic, Berkshire investing in Amazon simply means that they believe they are going to be able to get more money out of that investment than they put in, and in a reasonable amount of time, thus making it a value investment. The fourth point is the other guys can look for more opportunities than Warren can. Why this is important is because we are the other guys and girls. Warren says this because he is dealing with hundreds of billions of dollars now, which means he can't effectively deploy all of that money into smaller businesses. The other people in Berkshire are using smaller sums of money, so their field of opportunity is much wider, since they can invest effectively in much smaller businesses. Warren is essentially saying here that he is limited to buying big businesses, which ultimately means he can't execute on as many good investments. Think about that. We as smaller investors now have more opportunities in the market than the best investor ever. If that's the case, then we should be expanding our field of opportunity and not leaving smaller cap businesses off the table for our own portfolios. However, what I do find funny about this is that Amazon is actually a massive company, which Warren could have thrown billions and billions of dollars in. So personally, I don't think that this point actually applies to the Amazon investment, but it is still an important point for all of us smaller investors nonetheless. The fifth and final point is that the people in Berkshire who bought Amazon did so because they feel like they understand it as a business. This is such a key point for every investor, because confidence in your investments comes from knowing what you own. If you don't know what you own, then you will be affected by the next person you talk to who gives you their opinion on what it is you own. Warren also calls this your circle of competence. Warren's circle of competence is also why he himself has never invested in Amazon, and why someone else in Berkshire had to do it. Warren doesn't invest in what he doesn't understand, and he is perfectly fine to miss out on some opportunities if he cannot personally understand them. If you don't understand what you're investing in, then how can you accurately predict when you're going to get your money out of the business and how much it can potentially grow? He also admits that he didn't understand the internet sector back in the early 2000s, which again is why Berkshire didn't take advantage of businesses like Microsoft or Google early on. Warren is also still using a flip phone, not an iPhone or a touch phone. So I think it's pretty clear that he may not understand the potential of the iPhone if he himself would never even use one. How we as smaller investors can apply this point to our own investing is simply to invest in what we know. For example, I use Windows computers, and that's actually what I'm using to make this video right now. Since I use Windows computers and I understand how important computers are in today's society, I can look into Microsoft, which owns Windows, as a potential new investment. Simply by paying attention to the things we personally use, consume, or love, we can find new potential investments. Listen closely to what Warren and Charlie both have to say about the missing out on Google, because you'll see exactly what I mean by this.
Warren and I are a little older than some people, and
Damn near everybody.
and we're not the most flexible, probably in the whole world. And of course, if something as extreme as this internet development happens, and you don't catch it, why, other people are going to blow by you. And I don't mind not having caught Amazon early. The guy is kind of a miracle worker. It's very peculiar. I give myself a pass on that. But I feel like a horse's ass for not identifying Google better. I think Warren feels the same way.
Yeah.
We screwed up.
He's saying we blew it. And we did have some insights into that because we were using them at Geico and we were seeing the results produced, and we saw that we were paying $10 a click or whatever it might have been for something that at a marginal cost of them it was exactly zero, and we saw it was working for us. So
we can see in our own operations how well that Google advertising was working, and we just sat there sucking our thumbs. So we're ashamed. We atone. We're trying to atone. Maybe Apple was atonement.
When he says sucking our thumbs, I'm just glad he didn't use some other example.
Charlie and Warren are kicking themselves for missing out on Google when it was such a great opportunity for them. They were personally using Google and seeing great results from advertising through them. Despite the two using Google in their own businesses and getting fantastic results, they still didn't consider investing in it, and it blew right past them. What you and I can learn from this is to pay attention to the world around us, what we're using, and where the world is heading. By paying attention to our own personal habits and things we use and consume, we can find great new investment opportunities. So I'll leave you with a question. What are you using today that you think will only continue to grow and add value to the world in the future? And could this be something you could see yourself investing and profiting from? By asking ourselves these questions, we can start thinking like some of the best investors who ever lived. And that is pretty much going to wrap up the video. And if you enjoyed this video or you found it helpful, then please remember to just leave a like on it. Leaving a like on the video really helps out my channel and I really appreciate it. And with all that being said, again, I really hope you enjoyed this video, and I also hope to see you again in my next one.